G'day there. Welcome to the Closing Bell, recorded on the 1st of September. And today I'm going to zero in on the US 10-year bonds. I think that is really the crux of the situation for us going forward, how these interest rates really play out, the yield curve over in the US, the topping out of rates, when does it happen? What does it look like? What should you do once it does start to unfold? How will it look? So I think it's an important one because, it can make sense, I think, to be buying exposure to bonds as a pretty good hedge on your portfolio uh, because, either stocks fall over and yields drop, or yields drop and stocks rally. That's a potential outcome. But I think the odds are increasing that a drop in yields is coming. But I just want you to be aware that we haven't got the sign yet to really pull the trigger right now. But I want you to really understand the situation from a big picture to a short term, so that you can make your own plans about what you want to do as we see bonds either rally, which I think is getting more likely, or look, if yields continue to ratchet higher, we have to be prepared for that too. So let's get stuck into it. This is the US 10-year bond yield chart. So that's falling yields, which is rising prices for bonds. This is very long term, going back to 1985. So you can see, if we're looking at the yield, that's 10% yield there. That's all the way back in, the late 80s. And this is that bull market that we've seen for a generation, which has really inspired the bull market in everything, hasn't it? As rates go down and down and down, more money can get borrowed, helps growth, looking at future earnings, the tech stocks, as rates fall really low, their valuations go through the roof. So, this has been the source of the bull market. So as we're at an important juncture, it can really drive things going forward. So you need to understand it. So I didn't actually mean to delete that. So we've got what is this very long-term downtrending, and it's so clear, isn't it? The way it's moved, this very clear structure, rates peaking, a big fall in rates for multiple years. That's the 94 sell-off. That was huge. I was on the futures floor when that happened. It was quite incredible to watch. So many people got taken out on stretches during that big rise in yields. No one expected it because of the February 94 rise in rates. That was very unexpected from the Fed. Then we had, that's probably a better line is there, a big drop in yields, another rise, then another multi-year rally in yields, another rise for a few years, another drop for many years, another rise. So you can see this very clear pattern, which was really that you'd have the backup in yields, but then the next drop would fall below the previous low, wouldn't it? It was a pretty steady downtrend. And the point being, the trend down never really broke above the previous highest yield in the previous cycle, did it? It just kept going down until we got to a point where it was near zero. Completely absurd. 10-year yields down near 0.5%. And look, that's really what's inspired that kick up in inflation, pushing things a bit too far. And we are now at that period where they've chased down inflation, and it's not licked yet. But have a look at the way this has moved. It has broken out above that trend line from the past however many decades, and also above the previous high of the last cycle. So that's the first time it's happened since this generational rally began many decades ago. So from that point of view, this is big picture, fairly dangerous that, well, maybe not dangerous to say it, but to say that it is a possible shift in trend in these yields. And perhaps we're going to see something like this over the coming decade or two. So that's one thing to point out. It is a very big inflection point and a large break of a major level that the bonds have done. But as we look at how these yields have moved, let's look at the monthly trends. If we get that monthly trend shift, so the 10-month exponential dropping below that 20-month simple, I'll be pretty comfortable saying that we're probably going to see a period of dropping rates. So it's been pretty good as a signal in the past, but just noting, if we go up close, that we're not really at that point yet, are we? Now, so that is still a story for another day of the 10-month exponential dropping below that 20-month simple. That may be coming. And when it does, I'll certainly alert you to it. But the first thing that's making me think we are getting closer, is what I've talked about before, the fact that the yields often top out on some sort of a double top formation. It's pretty usual. If you see back in 2006, I've shown you this last week or the last few weeks, we have a peak in rates, they back off, they retest that peak, and then that's it. So it's happened many times in the shorter term. It's a bit shorter term there, but similar thing of these double tops, the retest here again, double top, and then that was it. So this is really where we're at, is retesting what is multi-decade highs of 15 years or so. So if it turns down from here, we've had the double top. If we get a monthly sell pivot or something, it's certainly going to be interesting from here, being wary of the fact that rates can drop. And just want you to note on the moving average convergence divergence, which is down here, MACD, which is usually an early warning sign, because the MACD is a relationship between the moving averages. So rather than just looking at how the moving averages are moving compared to each other, it's actually looking at the relationship between them. So the MACD will turn down as we see that turning down towards the 20-month. You'll get that early sign that momentum is shifting down. That's what that MACD is saying there when it crosses. So it's a bit of an earlier signal than just the moving averages. And it has been pretty good in the past. That's all I wanted to say about that. Was if we just look at, the early warning sign that it gave in the past, it has been pretty good at saying rates have perhaps topped out. You can see there, really solid as a signal saying when rates were about to turn back down. And also the old school idea of the RSIs and the bullish and bearish divergence. So on the yields, a bearish divergence developing, and the bearish divergence is when you have the high in yields, then you have a retest, which the yield can go higher, and then if it fails quickly, you'll see that the RSI here was high, it fell, then the RSI is lower. So what that's saying is you've got the price going higher, but momentum going down. That's the bearish divergence, which is saying, watch out. It could be about to drop in yield. So we've had that a few times, and it's just looking like that's probably one there, really pretty flat. You've got yields going higher, but then momentum dropping off, and down yields went. So it's just right now one of those situations. We've had the retest. Does momentum turn down? You can see the RSIs here. It's preparing potentially for that bearish divergence where you've got higher yields but lower momentum. So that's another signal there, just saying, well, watch out from here. You've got to, though, realize that the trend is still up, right? So I'm still allowing this trend to play out. If we break out above those highs and continue trending up through 4.5%, well, you've got to allow it to do it, what it needs to do, because you have had that major breakout from that multi-decade trend. So we could be surprised to the upside. That would surprise the hell out of everyone. Would be bad for stocks. So that's why right now is so important, watching how they play out. So let's just jump to the weekly quickly. So this is just the weekly on those 10-year bond yields, and that will obviously be a quicker signal if we get the signs of the trend turning down. So that 10-week moving below the 10-week exponential, moving below the 20-week simple, has actually been pretty good in the past at giving you a sense of what's going on. And the major point there is that we've had this double top. So we had the weekly trend turn down there, then the weekly trends turned up again. We've had a retest. So that's why I'm a bit more interested in this weekly, because if this second attempt at the high then turns down into a weekly downtrend, that's when I will pretty much be quite positive on bonds, and that the yield will start dropping. Because look, if you look back again, similar thing, looking back, you've got the rise in rates, the weekly trend turned down, we had a retest, double top, and when the weekly trend turned down after the double top, watch out, down it went. Similar situation here, pulled back, weekly trend down, one final weekly uptrend, retest. Then when the weekly trend turned down after the retest, yields dropped rapidly. So it's a similar thing, double top there, weekly trend down, watch out, yields are going to drop hard. So that's why, looking up close at this, I'm now, on tenterhooks, wondering what's going to happen here to these 10s. We've had the bad employment numbers, a few coming out. It'll be interesting tonight seeing what comes out on that front. You can see that after this retest, we are seeing a weekly sell pivot in yield. So that's a buy pivot in the bonds. So that's the first little sign. And look, let's see what the data comes out tonight. Maybe we're about to see rates really drop, but we do need to see that weekly go, don't we? And we see that, you will see me telling you, well, this is time to load up on some bonds. And let's see, as a good little hedge on stocks. And I don't know, if yields start dropping, maybe stocks do take off. But if growth really plummets, maybe stocks actually do turn down and yields fall, in which case having bond exposure is going to be pretty good, especially if you can get some pretty solid yields on them. So that really is the story of the day, I think, and the thing we need to keep an eye on and think about and plan for. because you do this right, you could be pretty happy down the track if yields really do start to rally from here. All right, well, that's enough for this week. I'll come back with more next week. Cheers.